Welcome to the Treasury Update podcast, presented by Strategic Treasurer, your source for interesting Treasury news, analysis, and insights in your car, at the gym, or wherever you decide to tune in.
Welcome to the Treasury Update podcast. This is Craig Jeffrey. I'm your host for today's episode, which is on embedded banking. What does this mean for banks and for corporations? I'm here with Dave Robertson. Dave, welcome to the podcast.
Thank you, Craig. Very happy to be here.
Let's get into it. We'll give an opportunity for you to describe what you do and your role at your organization. But let's start with, what is embedded banking? How do we think about this idea of embedded banking?
Traditionally, I think people have thought of embedded banking and they immediately think fintechs. And it's a bank opening up its platform so that a fintech can have a seamless experience with its clients. And that might be validating their account. It might be doing a KYC check. It might be executing payments on their behalf, moving money on their behalf. And that's been kind of the traditional definition. But I like to think of it as kind of the future of just standard Treasury working capital management through the banks. And what I think of is the friction and the boundaries between the bank and the corporate disappearing, generally through APIs, through real-time movement, real-time data. So the operating model of the company, the bank is basically sitting in as part of that operating model, and it is managing bank accounts, it is executing payments, reconciling, managing fraud, and all of that is just part of the company's operating system. Now, are we there yet? No. I think the deepest integration still is with the fintechs. It's with non-bank FI and with some niche segments like HOA management companies.
How would embedded banking look is if you were in an accounting system and you're going to run AP? How would that be different from the previous version of non-embedded banking?
There could be a couple of flavors because we've always had integrated payables, and that's generally been, we get to a point of like a quote unquote check run, although it could
payment run,
and we ship that off to the bank and the bank executes that. Obviously with a fintech, it's happening all the time, but as well with a company, it could be that once the payment's ready, it's staged and it's released for execution. Now, a couple things could happen at that point. There could be least cost routing put into it. It could be warehoused. There could even be contingent rules as to when that payment is released. And there could even be value-added services around the remittance and other activities. Supply chain finance could be interjected. So in embedded banking, these things don't really have to have a trigger. There's a structure where you've integrated the bank and the company, and the bank is now enabling the payments as part of the operating model of the company.
Is embedded banking always or mostly API supported or enhanced?
It's largely just because that is the way to have a call for the services to be pulled in seamlessly. I imagine you could do other formats of that, but APIs are the general approach that's used.
As we look at the business of treasury management, banks have a huge part of their business is treasury management. Sometimes they refer to it as global payments and treasury. Whatever the name of the half year is, they're talking about that. This is transforming that activity because it's perhaps less about individual services and more about integration. How would you describe the change that's taking place there?
I think there's a couple things that have happened. If we just look at the environment, you've had the financialization of companies. So Ford and Toyota now are finance companies, right? You've also had fintechs come in and just take massive swaths of the banking and financial space, whether that's consumer banking applications, things like Cash App, things like Chime, or it's B2B activities, largely around global payments or payment companies. So the demand for more intense integration has arisen partly because of these two factors. So once you become a financial entity, you can't be batch. You need that real-time liquidity, real-time execution. If I'm a fintech and I'm giving a business, I'm going to settle this payment in seconds or minutes. I can't have a batch process for that. So to some extent, embedded banking was a prerequisite to the financialization of companies and the growth of the fintechs. Arguably now, if I'm a corporate, I need to be real-time as well, ultimately, and embedded banking is a path to help me get there.
I guess when you're saying that it's not batch, there are these ongoing use cases that drive speed and nothing gets slower. Is it just for fintechs, or is this the ultimate shift? All of it's going to move to a more streaming environment. There's just use cases which are jumping over sooner.
I think that's a productive way to think about it, which is if you're a company and you don't really have a heavy financial component, can you operate batch today? Well, you probably can, but there's probably two challenges with that. One is ultimately with real-time payment adoption and with the need to basically monetize your AR and AP, you're going to want a real-time environment so that you're getting the best cost of capital, the best execution of payments, and that's going to drive you to more of an embedded banking world. The other thing companies have to realize is you might be batch, but the world is not batch. So if you take the Silicon Valley Bank failure, by early Thursday morning, you could see the stock price was giving all signals that it was going to fail. And indeed, if you went into social media, you could see people chattering about what was going on. So if you were just a happy batch company, I did my batch processing, I'll come back tomorrow morning. Meanwhile, this bank is failing. You could not get your money out, and the bank failed sometime around early afternoon. Now your payments aren't going out. It's not open Friday. Even worse, Silicon Valley Bank was funding fintechs. So if you were a company using a fintech payroll processor, how do you know that money's going out on Friday? Did it get queued up in time or not? So you may be batch, but the world is real time. So it's incumbent on every CFO to say, how much of my process needs to be real time today? Because if not, I'm exposed to risk, I'm destroying value, I'm getting delays in the financial value chain that's degrading my performance. And what's that going to look like over the next 3 years? And how do I prepare for that? The worst case for a company is waking up 3 years later and saying, oh crap, I need to dismantle all this batch stuff and move to real-time treasury. You don't want to be doing that reactively. You want to be prepared and doing it in advance.
Starting with your Silicon Valley example, there was a massive movement of payments out the door. It was over 40 billion on that Thursday, right? That exacerbated the decline. So I guess we go back to the Great Depression. People would line up around the block. Everyone's taking out $200 and $500 at a clip, and it takes weeks, and then they run out of cash. Here, it was several days, but really almost that one day was accelerated. So the real time had an amplification of that, perhaps. It was still going to occur, but just happened really rapidly.
Yeah, in a digital environment and with the data flows that we have among everyone. And then I think as well, you start to get this concentration of financial governance, the VCs, private equity, even the public markets, are kind of a collective view of the world. You actually have these segments that can move very quickly. And banks have to think about that as they structure their portfolios. What is my exposure? If my companies are here, where are they going to be in 3 years? How do I need to move to support them?
If you talk about moving to this more streaming environment, usually there's a bunch of technology that are at companies or at banks. Some of it supports faster, more immediate transmission. Others built on a different tech. You have to live with that and move with that. And so part of the delay might be your overall infrastructure, not just the switches.
Yeah, absolutely. I just recently attended a private fintech conference, and the companies there are very proud of their proprietary technology. And there's a reason for that. The implication is that these legacy technology platforms don't support a digital, real-time, automated, intelligent world. So you do see there are going to be more and more tools and services that people can purchase. But in the short run, there's a lot of proprietary architecture that needs to go into this.
Maybe shifting, Dave, to what's the impact? Maybe first on what's the impact on processes and the impact on people and roles? Where do you see the biggest shifts coming?
I think the biggest issue, let's start with the corporates, is that you're going to have a lot more automation and you're going to have a lot more engineering of policies and governance that can be digital and can be empirically proven. So what does that mean for Treasury? It's less about me doing my cash position each day, that operational stuff. If that's my job, I don't have a job in 5 years. My job is really engineering the Treasury, accommodating change in markets, change in the company's business model or business scope, supporting the vendor strategy, supporting the customer relationship, managing the financial flows in respect to the cost of capital around the buyer, credit exposures, the payables. And so it's going to be much more of an engineering and architecture role and a change management role. And I think it's going to take people that are highly collaborative and creative to execute that. On the bank side, banking is moving from selling required products with a very stovepipe set of responsibilities. Product defines the product, sales sells it, hands it off to implementation, then service takes over. It's going to be a much more orchestrated, integrated solution. We're going to see more collaboration. Implementation is part of the sales process now. They're configuring and they're defining the integration of the solution, not just into the technology, but into the process and the roles and the governance of the company. And that's a really hard thing to scale. If you look at the banks that do embedded banking well, they have defined expertise, but when it's time to solve a problem for a customer, it's kind of a scrum. They all come together and solve it. So there's going to be a lot more defined expertise, but the boundaries between the roles and the orchestration is going to become much more interspersed.
It seems like the movement to a scrum is also what happens to some extent with the data. It's now in the center as opposed to the silos where data comes from one area to another. It's processed, it's moved along, and then it's handed off somewhere else. There's the handoff management. They process it, move it along in this linear fashion. It seems like we're attacking it, and it's like data's in a central spot, and people are editing it, looking at it, all seeing it, as opposed to the telephone game of, you're passing the data on, and eventually something comes out at the end that may be, the complete conversation, or I guess the telephone game is usually to say how stuff can get distorted, but it's instead of linear, it's all multi-threaded at the same level.
Yeah, and I think there's two things. And if it were the telephone game, that would be a disaster, right? You get a payment on the other end, and it's not what you expected. You have this incredibly critical data that has to be locked down, which is now being processed by the bank, by the fintech, maybe even a third party is getting involved there. And so the rules around reading and writing the data and reconciling it have to just be very, very granular and precise. But the second thing for the bank is if I'm dealing with, let's say, a healthcare company and it's a medical office and maybe it's an esthetician, so it's not even insurance-based, they're going to have expertise around what kind of integration they need, what are the financing needs. So there's all this expertise that has to be shared. It can't be just in one salesperson's head or one implementations person's head. You've got to find a way to get that expertise and pull it together to solve problems that are increasingly far more complex.
If that's the impact on functions and people, there's quite a bit of change that's occurring, right? It's a different environment, different speed. What's the impact on mergers? I know we've seen at the beginning of 2025 some of the highest level of large mergers. What's the impact here?
I predict there's going to be a ton of merger activity. One, we have a favorable administration for mergers. The second thing is when I talk to C-level banking executives, there's still, it's kind of ironic, there's still this perception of regulatory scale. Once I become a SIFI, why am I not a $1 trillion bank? Once I get to 50 billion, why don't I get to 200 billion? And so there's that pressure. But the embedded banking, just generally the digitization, the automation, scale is just so much more critical. And you either are scaling with people, which why not be a $2 billion niche bank, or you're scaling with technology and people. And at that point, why not be a multi-$100 billion bank that's really leveraging scale to solve problems. So I think this kind of a trend is only going to drive more pressure for mergers.
Will that speed development or slow it down?
In the short run, it will slow it down. You and I both work with banks when they're in the middle of a merger. That's job one.
Job 1, 2, and 3.
You'd love to say we're going to do all the strategic stuff, and you'll still do some of that, but the appetite for it is much lower. So you will see these blips. And the other comment I'd make on mergers is getting a merger right is a very different proposition because of things like embedded banking and because of that deeper integration. So in the past, I did a merger. I basically had to get you onto my core system. I needed to map the new customer base into my products. The experience of the customer, the product and the core system are the tip of the iceberg. You can see the impact of the bank in the operating model, the roles, the processes, even the portal differences could cause one company to have a different set of processes than another. So now if I do a merger and I just say, hey, I mapped you over, and by the way, here's how my portal works. Have a great day. Here's your new banker. that's going to be a disaster. I think banks need to infer what is that operating model that I'm a part of with the customer, and how do I get them into this new operating model? And it might be that there are, these 4 key differences we want to alert you to. And by the way, they're going to make your life better. But we've done an assessment of how your working capital processes or your treasury processes are going to change. And we want to alert you to these things specifically. And there might be 20 different segments with 20 different keys in them. And so I think there's going to have to be a lot more thoughtfulness put into mergers, because you don't want to destroy that franchise you've just purchased.
Thanks for that, Dave. It'll be interesting to see the number of mergers. Maybe we'll come back at the end of the year to see if your projection held up on that. But final thoughts, what will this mean for corporates and bankers? A quick summary of what you see.
Yeah, I think the jobs are going to change radically, just given the pace of the change. And I'm already seeing it with some of my clients for sure. The days of the treasurer being domain expertise and oversight of operational functions with some strategic decision-making, I think that's gone. I think the treasurer is now architecting a operating model that has governance. They're picking what they do internally. What does their ERP do? What does other technology do? What banks and other partners play? And so they're really engineering the treasury model, not within the company, but within the broader market. And, depending on the needs of a particular industry, they might need to be finding adverse media on social media to pull in for their analyses. There's going to be so many more tools with AI and different things that really it becomes less about your expertise. You do need the expertise, but it's going to be much more about the critical rigor, building a system, maintaining a system, doing the what ifs about, somebody comes and says, we changed our business model now, we're going to be doing this with our clients. Well, how does Treasury support that? So much more collaborative, much more consultative, much more change management driven within the office of the CFO. For banks, it's really a sea change. And I see this thing that just makes me kind of smile, which is originally way back, and I'm old, so way back when Treasury management was growing, the Treasury management sales officer was a specialist role. And they came in and they knew Treasury, working capital, and they knew all the products. Now the Treasury salesperson is at risk of becoming a generalist. And they're bringing in all these specialists because everything's gotten more complex. I don't think that's sustainable to have a banker and a generalist treasury management person for a middle market portfolio. So what we're going to see is a lot more use case driven banking. I can add value to these companies in this way. I'm going to uncover it this way. What does that mean? It means a lot more scalable roles around sales enablement, portfolio management, data mining. And I think the salespeople, we're going to start to actually see banks, yes, build out some expertise, but really look for functional skills. Who can actually lead a client, uncover an opportunity, structure a solution using some tools, and lead the change for the customer. Within implementation, that middle office, back office, that gets automated. And really, I'm an expert in integrating into processes and technology, and I'm bringing value into the sales process. So I actually think even as we get more complex domain knowledge, there's going to be a much greater focus on functional capabilities that maybe we sacrificed a little bit on the banking side in favor of domain expertise. These new solutions, you're going to have people with critical rigor, communication, change management, leadership.
Yeah, thanks for that. And back to your engineering and architectural element for the role of the treasurer, I think those are really important things for people to think about. Thanks for joining me.
Yeah, this was fun. Thank you, Craig.
You've reached the end of another episode of the Treasury Update podcast. Be sure to follow Strategic Treasurer on LinkedIn. Just search for Strategic Treasurer. This podcast is provided for informational purposes only, and statements made by Strategic Treasurer LLC on this podcast are not intended as legal, business, consulting, or tax advice. For more information, visit and bookmark strategictreasurer.com.